Good morning and welcome to this Wednesday, June 3rd edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, had another pretty decent day on Wall Street yesterday. For those of you who aren't aware, I am a historian of the market, and I can tell you that we are in a very bullish period of the year historically. May 26th to June 6th on the S&P 500, there's an annualized return of 29%. So that doesn't mean that from May 26th to June 6th, we go up 29% every year. It means it's annualized. So you've got to take the number of days of the period and interpolate that over a 365-day year. But what it does tell us is that that annualized return of 29% is more than 3 times what we normally would expect throughout the year, because the S&P 500 over the last 70 years has gone up roughly 9% a year. And so if you're looking at 9% a year, you would expect the annualized return, through each day and through each period. If every day was created equal, you'd expect 9%. But this period has an annualized return of over 29%, or right around 29%, which is more than 3 times the average. So this is a bullish period, and this is one of the reasons why when folks say go away in May, I just don't buy into it. The logic, if you just take big picture, May through October doesn't do as well as November to April. The facts don't lie. That part's true. But if you're going to get out of the market beginning of May, you have to figure out another asset class that does better than the stock market. And I think you'd be really hard pressed to find that. The other thing I would add to that is that typically, when I look at the market and I go back and look at history, the real go away period, if you were going to have a go away period, it would start around July 17th and go through the end of September, right in the heart of summer. I think you got a lot of market participants that leave the market. Volatility picks up sometimes. You got the volumes lighter. It's easier to manipulate. And you also, I think, going into September, have a lot of folks that are just finally coming out with their dirty laundry as far as their earnings go. First quarter you miss, you're like, okay, rest of the year is going to be awesome. Second quarter you miss, well, second half of the year looks much better. By the time you get to the third quarter, if you haven't picked things up, normally you're like, okay, we know this year is going to be bad. Let's just throw everything in. And I think you get a lot of warnings in September as a result of that. But anyway, that's just my theory. But this is a good time of the year. That was my point, that we are in a pretty good stretch. The market's doing pretty well here. This period isn't like every other period, obviously. We're coming out of the pandemic. Market's trying to rebound out of what, really was a history-making type decline. Also in the news this morning, we've got the ADP employment numbers out. They were much better than expected. The market was expecting a loss of 8.66 million jobs, and the number came in at a loss of 2.76 million. So not a good number, but certainly a lot better than what the market was expecting. Later today, we got May PMI services, April factory orders, May ISM non-manufacturing numbers. None of those numbers are going to be good numbers. We'll just see whether or not they can beat expectations. Let's go ahead and jump into things. And right before I do just want to let everyone know, if you are new to Earnings Beats, that you can go over to earningsbeats.com. You can sign up for our free Earnings Beats Digest newsletter. That comes out Monday, Wednesdays, Fridays. We just had one out this morning talking about a couple of software companies. Both those companies are going to be reporting earnings, by the way, tomorrow. And going to be a very interesting day tomorrow with earnings. It was interesting last night with Zoom video conferencing, posting better than expected results. I think the way the stock was trading, Wall Street certainly was expecting blowout numbers, and they got them. And we'll get into all that in a little bit. But, if you haven't checked out this Earnings Beats Digest newsletter, sign up. Love to have you on board. It's free. There's no credit card required. Cancel at any time, unsubscribe, whatever. But I think it'll provide you some good trading ideas, some good education. And anyhow, love to have feedback too, by the way, about that Earnings Beats Digest. Anybody, send in to support@earningsbeats.com. Love to hear what you think of it. All right, let's move on to what happened in the market yesterday. You can see Dow Jones Industrial Average up 267 points. The S&P 500 up nearly 1%, up 25 points. The NASDAQ up 0.6%. That was about 56 points. We're now up over 9,600, getting close to an all-time high on the NASDAQ. But the leadership in the NASDAQ has been waning just a little bit of late, giving way to the Dow and the S&P. Also, mid caps and small caps outperformed on a relative basis yesterday, as you can see here. Mid caps up almost 1%, small caps up a little more than 1%. And I honestly look at this chart much more bullishly now. I think, we were chopping back and forth beneath the moving averages. Now we're breaking out and trending up above the moving averages, above the 20-day, which is above the 50-day, and everything's rising. Hard to argue bear market with that kind of configuration. XLE led the sectors. All 11 sectors were up yesterday. You can see the XLE was the leader, closed over 40. We're trying to fill this gap over here. I like what's going on with energy. I like what's going on in the overall market. As I said before, we've been mostly into stocks that have been leading. So we're looking at technology and healthcare and so forth, some of the industry groups, that have been leading as well. But I find, as stocks and different groups break out, the more the merrier from a bullish perspective. I mean, I wouldn't get too caught up in the fact that, hey, the NASDAQ's not performing as well. The NASDAQ's going up. Technology is going up. Right now, I think healthcare is more consolidating, but everything is in a much more bullish pattern now. Really like what's going on with the Dow. I'm going to talk about at the end of the show, the three you must see are three Dow components. And they're just looking a lot more bullish than they have. And I think that's great for the overall market. But energy doing well. Materials, you can see having a good day yesterday, up almost 2% in a nice uptrend. Industrials, we had the industrials and the financials that were really lagging along with energy. And now look at them. They're all trading up above the 20, which is above the 50. They're all trending higher. Everyone showing that PPO up on, above the center line, pointing higher, which means when it's pointing higher, what I mean by that, because I get that question from time to time, when I say something's pointing higher like the PPO, I just mean that we've got bullish momentum accelerating. The short-term moving average, the PPO, if you look at this 12-26-9, that 12 and 26 refers to the 12-day EMA and the 26-day EMA. So what this is the difference between those two on a percentage basis. And as that's going up, it's telling you your short-term moving average is moving up faster than your long-term moving average, which is what you want to see. That is the sign. That is the true sign when you look at price action of price acceleration and price momentum moving to the upside. And that's what we're seeing almost across the board. You can see technology's flattened out a little bit, but technology had a huge run. Technology's been taking a little bit of a back seat. I think we're going to see another big move up in technology. I think your PPO will turn higher. All right, and then there's discretionary, did pretty well. All right, let's take a look at, and by the way, today's futures, Dow, last time I looked, was up 236. NASDAQ was up like 7 points. So clearly money right now is looking into some of those areas that didn't perform as well, that are just now starting to do what many of the NASDAQ stocks did, healthcare, technology, what they did 6 weeks ago. That's where the Dow and the S&P seem to be at this point in time. So I'm not sure who's going to outperform who over the next couple of weeks to a couple months. I'm going to continue to watch that and monitor that. But if we've got a bull market and everything's going up, well, we'll have a lot to pick from. All right, next up, 10-year Treasury yield. Always like to look at the 10-year Treasury yield, and I'm going to talk a little bit more about this in just a few minutes and show you history and how the correlation between the 10-year Treasury yield and the S&P 500, how important it can be, especially during a bull market, secular bull market. But we'll get into that in just a minute. 10-year Treasury yield right now is at 0.71%, up 3 basis points. That's usually good for the market. Because it does indicate that you're seeing selling in treasuries. That's why the yield goes up, always that inverse relationship. So if you got selling in treasuries, proceeds are coming in from those sales, where's that money going to go? If it's rotation, that's a bullish rotation for equities, money coming out of treasuries. So if it goes into equities, which it typically does, that would be bullish. Now, right now, we're just sideways consolidating here in the 10-year Treasury yield. But if we break out, I think that just adds more fuel to the fire for the bulls going higher. And I know a lot of folks say, well, how can the market go up any higher? I mean, we're getting all these horrible reports and NASDAQ's almost at an all-time high. This is just total disconnect. The stock market's crazy. Stock market's not crazy. The stock market's looking ahead. The stock market sees that things are going to be much better down the road. The stock market's pricing in earnings growth at historically low interest rates. I think the stock market's going a lot higher. And the reason I think the stock market's going a lot higher is I think everyone that's been hunkering down in treasuries, when you start to see the numbers that many of these companies are going to post later in 2020 and into 2021, then you're going to see money rotate in a big way out of the treasury market and into stocks. That's what I think is going to be the big driver for the stock market going forward. All right, so let's take a look at that relationship between stocks and bonds. This goes back to 2000 to 2000, all the way through 2002. And what I wanted to show you was the relationship between the 10-year Treasury yield and the S&P 500 during bear markets, so that you can see the difference of what's been taking place for the most part in this current bull market. First of all, back in 2000, you can see, I mean, if you look at the charts, they almost look like they're the same during a bear market. When you see the 10-year Treasury yield going down, that means money's rotating into treasuries. And so in a bear market, what happens is money rotates out of the stock market and into the bond market. Now you have money, you know, 401ks and things like that. Money's coming in to both stocks and bonds. But when you're in a bear market, professionals are literally getting the heck out. So you might have some money coming in at the beginning of the month. And I did an interesting study. You know, I talked a little bit at the opening of the show about the historical side of the market and how it tends to do well during certain periods. The 28th, well, really about the 26th of the month to the 6th of the following calendar month, of all calendar months, if you add them all up, that's the most bullish period of the month. And what I found is even during bear markets, when we had this horrible action, I think I ended up going back and looking at the S&P 500 over the last 70 years, and I took a look at the worst 16 or 17 years of the S&P 500. And I just took those years and went back and did my historical study on it. And the beginning of the month still generated positive returns, even in the 16 worst years of the S&P 500. So money does come into the market, even in bad years, even in the midst of horrible bear markets. People are putting money in their 401k and that money's coming in. But professionals are taking their money out. And so the S&P 500 is going down, the proceeds of which, a lot of it's going into the bond market, which when the economy is slowing, you want to be in the bonds. I mean, interest rates, you're going to get a lot more return than you are in the stock market while the stock market's going down. So you can kind of see this relationship. And down here at the bottom, I've got the correlation. It's not a perfect correlation, but for the most part, you're going to see positive correlation here. You'll see a little bit more negative or inverse correlation when we're in a bull market, but in a bear market, you get a lot of positive correlation. All right, so that was 2000 to 2002. So let me show you 2007 to 2009. So that's what we have going across here. Looks pretty similar, doesn't it? S&P 500 going down, 10-year Treasury yield going down, then we start reversing back to the upside. And once again, you see that correlation very strong, mostly positive, not 100%. We have periods where we go opposite. But for the most part, when that 10-year Treasury yield's going down in a bear market, usually stocks are going right down with them. Now let's move on to, this is 2014 to 2016. If you remember, we had a lot of choppiness in the S&P 500, had a huge run up in 2012 through 2014. And then we just ran into a lot of choppiness in 2015. And 2016 was a little bit of a scare. I actually turned a little bit more bearish, probably more bearish than I have at any point in the last 10 or 11 years, right here when we were making this breakdown. And I'll show you this in just a sec. But notice the S&P is going up while the 10-year Treasury yield's going down. That's kind of odd. How does that happen? Well, it happens because of rotation. When we're in a bull market, yes, money goes into both. You got money coming in from 401ks, sends the S&P 500 higher. Money comes into bond funds, sends the yield lower. But then you also have rotation that takes place. So money comes out of the treasuries and into the stock market. That sends yields lower and sends stocks higher. or actually, maybe I said that wrong. Money comes out of the treasury market. When money comes out of the treasury market, the sales actually, you'll see temporary moves to the upside in the yield because the yield moves opposite treasury prices. And usually when you see these moves to the upside, that's usually coinciding with some pretty good moves in the S&P 500. So here, I mean, you can kind of see these explosive moves when the yield starts to make big moves to the upside. But overall, you still pretty much have this positive correlation with just certain periods. But the look of the chart's different. It looks like the other two I showed you, the yield was going down, looked like the S&P was going right down with it. In this case, the yield's going down, but we're going higher. This is the sign of a bull market. This is what happens in the relationship during a bull market as opposed to a bear market. When yields are going down and the stock market holds prior lows or even goes higher during the yield, I mean, here you can see the yield going down. 2016, this is why I thought we were possibly going to be in a lot worse shape back here. When we made this break below these prior lows, we did so with the yield breaking to new lows. And we also did so with, it's not on this chart, but the XLY, XLP, consumer discretionary versus consumer staples, also broke down on this particular. Actually, I wonder if I can pull that up just real quick here. See this right here? The XLY versus the XLP breaking down. I put a puzzle together when I'm looking at the market. I don't just look at one signal, one PPO line, one relationship chart. I try to put all the pieces together. And when I saw this breaking down, I saw the yield breaking down, I saw the S&P breaking down, it's like, okay, now we got to be really careful. But what happened was, and hey, technical analysis, you got to be ready to adjust. What happened was the yield kept going lower, and S&P 500, that was a false breakdown. We came right back up. Not only did we come back up, we went right through the 20-day, right through the 50-day. That doesn't happen in a bear market. Just doesn't happen. So we got the yield going down. We got S&P going back up. And so you had to quickly look at this and say, hey, the thing, it's not that bad. It's not a bad, we're not in a bad situation anymore. Now let me fast forward to where we are right now, because here's your yield going down. This was pre-pandemic. Yield was going down. S&P was an all-time high. I mean, things look great. Then the pandemic hit, the scare, the media. I mean, just throw everything in, kitchen sink, baby out the bathwater, everything. The yield went down. Market came crashing down. But notice what's happened here over the past 2 or 3 months. The yield is still down, almost where it was back in March. Look at the S&P 500. This is going up without even rotation coming from the yield or from the treasuries. We haven't even seen rotation back up to the upside yet in the yield. When that happens, that means money's coming out of treasuries. Where do you think that's going to go? We're going to break out. We're going higher. We're in a secular bull market. I mean, you can argue bear market all you want, but as long as the S&P and the Dow and all of the different sectors are breaking out and moving above key moving averages, and you're seeing relationships like this, I don't know how you can argue bear market. I just don't. I still see articles. Folks are saying, well, bear market rally is going to end here. Whoops, no, it isn't. It's going to end here. Whoops, no, it isn't. It's going to end here. Whoops. A lot of oopses. We're breaking out. All right. Will we consolidate over the summer? Maybe. I mean, we've come up a lot. There's still a lot of uncertainty out there, but I would not bet against the market. I certainly would not be shorting this market. Just wouldn't be doing it. We're in a secular bull market. I'm not going to go over those charts, but I've shown that plenty of times. All right, let's talk a little bit about earnings, because Zoom, this is probably the one report that I was looking forward to more than any. And I actually held the stock into earnings, which those of you who follow me pretty closely over the years know I've always said that's a no-no. But some of these companies have made such big moves with earnings. It's like, if you're not in with earnings, I'm willing to take the risk, because if the stock pulls back, and I did lighten my load a little bit, but if the stock pulls back after its earnings report, I'm going to be buying more. If they beat top and bottom line, and they're looking the way Zoom's looking, if Zoom were to pull back today or anytime in the next couple of days, couple of weeks, and go back and hit that 20-day moving average, I'll be adding. I really like Zoom. 20 cents was their earnings. Market was expecting 10 cents. They doubled earnings expectations. I can only tell you from my days working in public accounting and doing valuations that when you start seeing companies post earnings growth like Zoom is posting right now, if Wall Street is comfortable that a company like Zoom is going to continue to grow its earnings faster than what they previously forecast, their valuation is going to go through the roof. And you've also got a lot of folks betting against Zoom. Still got a lot of shorts out there. And there are a lot of companies that their shorts are heavy on that make sense. Zoom does not. And I think this is one you're going to have volatility. So, you could get that $30 pullback at any time. And we've seen this. We've seen huge pullbacks in Zoom. Now their earnings are out. I wouldn't be surprised. If I'm going to be watching them, if we get a positive reaction, go up for a couple more days and then get a reversing candle, I'll probably get out from a short-term trading perspective and hope I can get back in a little bit cheaper. But I still think the overall long-term chart here is up. All right, CrowdStrike, another one that has been doing very well during the pandemic. They came out, they beat. And by the way, last time I looked, Zoom was about flat in pre-market. They were all over the place, down 10, 12, 15 bucks last night. I wasn't really following it that closely. I know at one point they were down 10 or 12. And then came back, and last time I looked last night, I think they were up 3 or 4, and then flat this morning. So there's going to be some volatility. CrowdStrike was up 8.25% pre-market last time I looked. They came in at 2 cents. Market was expecting a loss of 6 cents. You can see, though, a lot of it's being priced in. So when we get this gap up, is it going to hold? Can we get through this level? And I would be watching 100.59. If we open above that, that's a good sign for CrowdStrike. If we open above 100.59, I like that. Doesn't mean we won't pull back, but I think if we do pull back, we'll probably strengthen again this afternoon into the close. If we open below 100.59 and trade up above it intraday and then come back down and close below it, that could be a short-term top. I don't like false breakouts at major resistance levels, especially after news comes out, because this could be all of the buy on the rumor, and then if you fail at the 100 level, you could have sell on the news. So this is one I'd be careful with. I like the company. I mean, don't get me wrong. Just because I think it could pull back doesn't mean I'd short sell it. I definitely would not sell short anything. But if I was long, I would certainly think about at least taking something off the table with the idea of being able to get back in cheaper. All right, one stock that's having a very strong morning today, they reported last night. It's a smaller software company, and this is one that was a darling of Wall Street all the way back here in about November and then kind of fell apart. But this is Digital Turbine, APPS. I looked and they just matched expectations, 5 cents versus 5 cents, but stock is up almost 17% pre-market. It was up around $8. So still got some overhead resistance. I wouldn't chase, but especially without the earnings beat, I'm not quite sure. Maybe they raised guidance or something, but things were looking pretty good there. The worst one that came out last night in terms of response was HQY, which is Health Equity. This stock was down 7.6% when I looked last. So we're talking about maybe $4.50, something like that, which would take us down closer to 58. That's right around the 20-day moving average. 20 days, 57.83. I wouldn't be surprised. Well, they did miss. They came in 43 cents versus 44. If they had beaten and they had gapped down to their 20-day, I'd probably be a buyer. Since they missed, I still think the stock, just because we're in a bull market and most everything's going up, I think the gap down probably will be bought. But I wouldn't do it simply because they missed their earnings. This morning, a couple others came out. Campbell, CPB. Oops. Campbell Soup, CPB, came out with their numbers. They were up a little less than 1%. They beat 83 cents versus 76 cents. Lots of overhead resistance up here near 54, though. So let's see if we can get that breakout. Goose, Goos. This is Canada Goose Holdings. They actually they matched at loss of 9 cents, which is what the market was expecting. Stock's up 5% pre-market. Still got some work to do. It's got to get through 25. I'm not going to be too interested until I see at least that breakout, but it is up in pre-market. American Eagle. I thought I was going to just change the name. Amigal. American Eagle, AEO. Stock has been showing some strength of late. They had a huge miss. Market was expecting a 24-cent loss. They had an 84-cent loss. But the stock's up 2% in pre-market. I think a lot of what's going on is even the beaten down stocks, the market is now saying, you know what? I think the economy is going to be stronger, quicker than we think. Even the beaten down companies are starting to rally and starting to look better technically. And that's why I was saying, top of the show, where do we go for investments? I think right now we're just kind of up in the air. I still like the stocks that have been doing well the past couple of months, but they've been taking a little bit of a back seat. And I don't know if that continues. We'll have to continue to watch that. But American Eagle definitely looking better on the chart. You can see it's just rising above the 20. You see the difference here? Above the 20, right back down. Above the 20, right back down. Above the 20, right back down. Now we're above the 20. The 20 is above the 50. We're starting to put higher highs, higher lows in. Company comes out with horrible news, and the stock's up another 2%. That's a pretty good sign that a lot of the sellers are out of a stock. And also printing a double bottom and taking out the high in between these lows is kind of a big deal as well. Let's keep moving. Just wanted to mention a couple upgrades. CHRW upgraded this morning. This is C.H. Robinson Worldwide. It's in the trucking. Talked a lot about the truckers. Look at the truckers. Yeah, does that look like a bear market to you? Truckers breaking out 52-week high. Transportation stock breaking out in a bear market. Really? Microchip. I tell you, this is one of the semis that has really begun to turn around in my view. I like what's going on here with the volume coming in, holding the 20-day. The accumulation distribution, which I used a lot back in February, March. I didn't like the stock here. And it's still the accumulation distribution not showing well. But on a relative basis, Microchip now has moved to about a 3-month relative high to the semis. And the volume coming in, it's starting to look a lot better. It's still got overhead resistance at 110, but I'm definitely keeping an eye on this one. A couple of downgrades today, ACN, ECL. I'm going to pull that one up, ECL, because that had been on a roll and had broken out. It was downgraded. Had a long tail to the upside. Over 220 yesterday, closed at 212. So I wouldn't be surprised, a little short-term action to the downside, but I'd watch that rising 20-day moving average. I think this chart actually looks pretty good. Norwegian Cruise Lines downgraded. I think it might have been Morgan Stanley. Somebody, I think, lowered their target from 14 to 13. And this is one area, this stock hasn't broken out above these highs yet. I know, we're starting to see more volume. They're looking better. They're above their 20, above the 50. They still got a clear price resistance. We get a close above 20, and then I think you're probably going to see an uptrend that can hold and can be sustainable. Rising 20-day moving average would be best entry on any of these types of stocks, because if it breaks below the 20, then you don't have a uptrending stock. I would get out. So if I can get in close to the 20, that's when I would feel best about a stock like this. All right, 3 you must see. I'm going to give you 3 Dow stocks. And the reason I'm giving you these 3 Dow stocks is they're just starting to act a lot better. The Dow is acting better, and Dow Jones. And one of the reasons why yesterday's leader, I think, in the Dow was Dow Holdings, breaking out, volume picking up. It's gotten through gap resistance. It's gotten through all these prior tops, trading above the 20, above the 50. They're all rolling higher. PPO accelerating. These are companies that were beaten down. These were the ones in the ashes. Look at the AD line. This was a horrible stock. It was one I wasn't paying any attention to. But price volume trumps AD lines. Price volume trumps everything in my view. So I'm not going to say, hey, I'm going to short it, or hey, this isn't a good stock because the AD line's down. It's trending higher. Looks good to me. So, do I think it's as good? Would I be as interested in Dow as I am Zoom? No. Zoom's more volatile. Might lose a lot more quickly in Zoom. But I like the growth story with Zoom. So I'm more of a momentum trader, so I'm going to be more a fan of Zoom. But I really like what's going on here with Dow. How about American Express, AXP? Breaking out above this triple top. Pulling back, basically holding support, now turning back to the upside. PPO strong, the configuration price above the moving averages. Again, accumulation distribution isn't great, but even these stocks are moving higher. How about Travelers? Your final three you must see. Travelers, and now we've got the market open. Travelers broke out yesterday, and it's extending it this morning. And this accumulation distribution actually doesn't look bad. But this is another chart that was, you know, when you're looking at the market and you're trying to decide, well, can the Dow continue or can the Dow move up? Well, when you start looking at all the components and you see stocks like Travelers rolling over in mid-May, you'd say no. You know, you got too many broken stocks. Well, we don't have broken stocks. Now, we don't have many anymore. More and more are breaking out. And I think that is just going to add to the gains. And then the people that are sitting on the sidelines have to say, okay, at some point, when do you get in? I mean, watching the market go up day after day after day. When do you get in? Watching the VIX continue to drop day after day after day. I tell you, the VIX drops below this low over here at 25, and we could see a lot more money pouring into the market. That's going to be a key level to watch right here at about 25. All right, one quick look at the market, and then we will sign off here. Got the Dow up 228, S&P up 21. NASDAQ actually doing a little bit better than it was earlier, but it's still underperforming on a relative basis, but it is up 32. And by the way, let me show you this NASDAQ. Actually, I'll do the NDX. NDX is at 96.75. 96.75. The all-time high in February was 97.18. That's the high all-time high close, 97.18. We're at 96.68 right now. We are about 0.5% away from the NDX breaking out to an all-time high. That does not smell like a bear market to me. All right, that's it for today. Everybody have a great day. I'll be back over at Stock Charts TV doing the show tomorrow. Of course, it'll be pre-recorded. And then I'll be back here, Earnings Beats, next Monday. Everybody have a great rest of your week. Happy trading.